the kind of dirty secret of the RIA industry is that a lot of firms don't grow at all. They don't grow organically. In fact, they're probably net negative flows. And it's the market appreciation that's propping them up. And so I think that a project like Growers shows, yeah, it's really, really hard. It takes a massive investment to grow organically. And these are the firms that do it. And maybe they can be an example if you're an early to mid-career advisor of how you can do it.
Hey, everybody, welcome back to another episode of Next Mile. I'm your host, Kyle Van Pelt, co-founder at Milemarker. And today I have got Ian Wenik from Citywire. He is the editor there. He doesn't really need much of an introduction on that. But what you should know about Ian, if you don't already, is he is a wealth of Super Bowl facts. He can name every team, coach, and quarterback and MVP of pretty much any Super Bowl. Is that right, Ian?
Yeah, I mean, this is the question. Are you going to quiz me live?
Oh, maybe. We might just throw one in there, but I'm not going to do it right now because you're expecting it. I might throw it in when you least expect it. But thanks so much for joining the show, man.
No, thank you for having me on. The pleasure is all mine.
Yeah, it's a pleasure on our end as well. Ian, I ask every guest the same first question that comes on this show. You're not going to be any different. This industry is very unique. Some people have a really traditional path to this space. Other people didn't even know this space existed, and they came in the side door after maybe a first career or something like that and did something totally different and ended up here on their own path. But what I've found is whether your path is traditional or untraditional, everybody has what we call a money moment. And that's a moment in your life where the light bulb goes off and you go, this is it. This is what I want to do. So for you, obviously journalism, that's been around forever, but how did you end up in this industry? What was that money moment that led you to the financial services industry, writing about it at Citywire?
Yeah, well, it was kind of foisted upon me. So for context, I used to write about sports. That was the main thing I wanted to do through college and grad school. And to make an extremely long story short, I did my master's year at Columbia. I took the business class and the sports class while interning at Newsday. Business class was supposed to be exploring business reporting in a fun classroom environment. Sports class was to network. I found the sports class depressing, the business class exciting. And the light bulb moment was I had gone up to ESPN's campus in Bristol. I had done about 12 interviews over 2 days, and I thought I had a job there. And they kind of ghosted me. And I said, okay, if that's how they're going to treat me after all the investment I made in myself, then I'm done. And so I made a conscious decision to go all into business reporting. I was interning for a website called The Deal. I was covering Chapter 11 bankruptcy. I got to actually break a couple cool stories there. And then I jumped from that to a trade publicly covered the distressed debt markets, and then ultimately wound up at Citywire after a friend of mine from that business reporting class said, the water's warm, come on in. So that business class was what set me on this path here today.
That's amazing. That's amazing. So you'll probably find it flattering because I do think that in many ways you're kind of like the Woj or the Adam Schefter of the RIA or financial services industry. Do you agree with that or no?
You're too kind. I think that maybe the best analogy to make is that I probably spent a similar amount of time texting people trying to get information. But, you know, I think that the main difference is that those guys, I think, live off social media, tweeting stuff out minutes before everybody else. And I think this business, it's a little bit of a different demographic, different type of culture. So obviously for us, for me, getting a scoop out is less about a tweet and more about getting a full story out and getting the newsletter out.
Yeah, well said. All right. Speaking of getting a story out, as of the time of this recording, you just recently released the fastest growing firms in the RIA industry. This is one of the things that's looked forward to from Citywire every year. Maybe a softball question, but what are some of the common themes amongst the people who end up on that list?
Well, this gives me a chance to plug our own podcast, in which I actually discuss some of these themes with our editor-in-chief, Alex Steger, and our great reporter, Alec Rich. And, you know, just to give people some context and background on 50 Growers Across America, if you've never read it before, 50 Growers Across America is a project in which we look to find as many as the 3 fastest growing RIAs in each state around the country. The way that we do that is that we use SEC ADV data. This year we sourced it through Fintrix. And what we do is we create a number called a growth factor. And what that is, it's a weighted blend between a firm's year over year AUM growth, the raw number, percentage of AUM growth, and the employee headcount growth. And the reason why we have those 3 factors weighed in is because if we're just going by raw AUM growth, as you know, with the compounding effect in the market, that's just going to reward the big firms getting bigger. So the reason that we have the employee headcount growth and factor and the percentage of AM growth factor is to try to get an eye on and spotlight some of those smaller firms that are growing by leaps and bounds. Now, to directly answer your question in terms of common tactics, themes, I mean, look, I think you see a lot of these mega firms. I mean, Creative Planning is on there, Carson Group is on there, Hightower is on there. You see a lot of these firms with institutional backing that make acquisitions or recruit advisors on a regular basis. That's something where we call it like a positive feedback loop, right? Momentum generates momentum, deals generate deals. Once you generate like a Creative Planning, once you have a track record of being able to integrate a firm, keep the clients on board, keep the advisors happy, you're going to have those iBankers who handle the sell-side engagements. Well, they'll trust you with more deals. They think, all right, you can get a deal over the line quickly. Carson Group, I will put my clients in front of you. So that's on one end. As we're talking about organic growth strategies, I mean, look, that's the secret sauce for a lot of these firms, not to use too labored of an analogy, but you see things like interesting niches. A good example would be Ulrich Investment Consultants in New Mexico. They have this tremendous specialty working with Native American tribes. You also have a lot of firms that are really good at finding referral sources, whether that's through the Schwab Advisor Network referral program or the Fidelity Wealth Advisor Solutions Network, or in the case of Integrated Partners in Massachusetts, they have their own network of accounting firms that refer clients out to you. So it kind of comes down to three core things, I feel like. Good client niches, clear expertise in a niche, ability to work large referral channels, and then on the M&A side, the institutional backing and the internal capabilities, the internal investments to integrate and acquire smoothly and quickly.
That's super interesting. I feel like there's a lot to unpack there. First and foremost, shout out to Fintrix, who's a Milemarker partner. I'm glad that you used them, and glad they're getting a shout out on the podcast.
Guys, I dump so much information out so quickly. My brother always tells me you speak way too fast, slow down.
No,
so I apologize in advance.
No, it's great. I think it's fantastic. It's just my speed. I was trying to figure out where I wanted to take it from there. So let me start here. This is a core foundational thing. So there's two ways to grow, right? There's organic and there's inorganic. You touched on that a little bit. A lot of the powerful organic growth sources are figuring out those referral relationships with the custodian or niches or things like that. Do you think that the inorganic is going to continue? And let me add a layer to that question. I'm finding it very fascinating that as those really big ones at the top of that list get bigger, the deal sizes also need to get bigger, because acquiring a $400 or $500 million shop just doesn't really move the needle anymore. Whereas you really have to start hunting bigger game. And so that's opening space maybe for more the middle of that list or the bottom half of that list to acquire those types of firms. But what do you think that trend is going to look like with the inorganic growth continuing, or is it going to slow down?
I think that the bottom line is that what's driving so much of the M&A in the industry right now, it's time. A lot of these firms, big firms, they sell either because they have succession planning needs, they can't finance an internal succession, or if you're already institutionally backed firm, like a Carson Group, an Allworth Financial, Wealth Enhancement, you're in the market because your private equity owner has a expiration on that play clock. Typically, these PE firms are invested in 4 to 7 years. And this is what makes me feel dated, is that I see firms whose sale processes I broke in 2021, 2022, 2020. They're getting ready to go to the market again and take those PE backers out. So yeah, I think you'll see a lot of these big firms continue to move up the private equity value chain. I think the concern that I have, and this is what you've kind of alluded to a little bit, is that once you get to a certain point, the number of institutional investors that can cut the equity check necessary to support the valuations at the high end, well, the number of firms that can do that aren't banks or asset managers that a lot of advisors who join the RIA channel don't want to work for in the first place, there aren't a lot of those investors out there. And so the question is, okay, well, what's the end state for a firm like, I'll use another example, Creative Planning. What is the end game for them? Do they try to IPO? Do they sell to a sovereign wealth fund that could hold them in perpetuity, similar to what CI Financial, the parent of Corient, did with Mubadala Capital, affiliate of the Abu Dhabi and the UAE, did? Do you sell it to a club deal, a consortium of private equity investors? But then the issue you have there is that you have a much more muddled ownership and leadership structure with 5 to 6 private equity stakeholders it's a little bit harder to see kind of who is really ultimately calling the shots. And that's kind of the question, is what is the end point for a lot of these big firms? And I think with the IPO market looking rough, it makes stuff like the sovereign seem a little bit like a more of an attractive option.
Yeah, I think there's interesting parallels as well on that side, because you'll see like a small PE company get in earlier and they'll trade that asset up to like a mid-sized PE firm when they've kind of extracted the value out, and then the mid-sized PE will trade it up to a bigger one, and you kind of keep going. I think this is what you're getting at, is at a certain point, you're either going to have to put together a bunch of big ones to make the trade, or you have to do something different. But with that being said, do you think that's also going to happen on the RIA space? Do you think some of those names you mentioned, the Creative Plannings, the Carsons, the Allworths, are they going to start buying some of these mid-sized consolidators that have put together maybe a couple 10 billion? And is Peter Mallouk going to call one of them up and say, hey, let's trade you into this and we're all better together? Or is it still going to be individual shops, you think?
So I feel confident that is something that's going to happen eventually. For me, the question is when. I think more importantly, who is going to be the first mover? And this is the problem that we had with the IPO market, which was that, again, I'll go back to CI Financial and Corient. The Corient problem was that when Corient first came into the marketplace in 2019, 2020, 2021, they were paying 1, 2, 3 EBITDA turns over the competition because they didn't have a track record of buying, like what we talked about earlier. So they had to pay above market multiples to get deals done with established firms. And so much of what's driven this consolidation has been this idea of the multiple arbitrage. Yeah. And so when CI Financial tried to spin out Corient needed to get a valuation similar to what LPL Financial has now, which is in that 25, 26x earnings range, similar to what Creative Planning got when TPG came in. But instead, the issue, I think this is the issue with the public markets, why the IPO market can be so frothy, was that I think the public markets view these RIAs as closer to asset managers, which I think is not an entirely fair comparison. And so what that meant was that, okay, if CI took Corient public, well, it would probably go public at a 13x multiple or a 14x multiple. Well, if you're going public at a 14x multiple after paying 15, 16, 17, 18, all you're doing is lighting money on fire. And so that kind of got closed off as an option. And yeah, I feel like you're going to see this aggregation you're going to end up seeing some of this aggregation, because where are they going to turn? None of these people are big enough to do a public exit yet, except maybe Creative. So someone has to be the first mover and get a test case valuation for what it looks like of a merger between strategics.
This podcast is brought to you by Turncast. We make game-changing content for fintech and financial services companies. Learn more at turncast.com.
Hey, this is Judd Mackerel. Thanks for listening to this show. I just wanted to ask you one question. What's your technology and data strategy for 2025? If you can't clearly answer that question, I'd love to talk. We are spending some specific time with select firms to really go deep and help you clearly answer that question. We believe that it's one of the things that often holds back firms from really achieving their potential, from really achieving growth, and really getting a lot of the things in the position that they need to be. The things that are holding up the way that you scale, like your workflows, how you manage data around your revenue, how you report all of that to your advisors, and getting clarity in all those things. I'm sure there's a lot of very specific things to your business that are really important as well, and we'd love to talk about that. If this is interesting to you, hit me up with an email. My direct email is jud@milemarker.co, and I'd love to hear from you, hear what you're working on, hear what your strategy is, and see if there's an opportunity for us to help you get more clear on that strategy in 2025. Thanks.
Well, and you brought up LPL. I think they've laid the pathway for this. We talk a lot about the RIA market, but LPL has been scooping up larger broker dealers, ones that used to be the acquirers, and then all of a sudden, LPL bought one of the acquirers as they further distance themselves. And obviously Cetera and Osaic are still up there as the big three, but they provided that model. Obviously they have the public markets to be able to make that a little bit smoother from a financing perspective, but they were, it seemed, the first one to really break the ice on that side as well.
Yeah, absolutely. I think that LPL is I view it as kind of the bellwether for the industry. We can get into a little bit about what kind of supports their valuation. You can argue a little bit, it's a little bit of a cash play, But no, look, they're, in my opinion, one of the most fascinating companies in the entire industry right now.
Yeah, why is that?
I think for me, it's because they've expanded into multiple channels. So again, dating myself, I remember when the strategic wealth services wirehouse lift out business was the new thing on the block. Now that's a 5-year project. You have the employee channel. It's also interesting. You have Commonwealth, and look, they say that they're going to keep Commonwealth as a separate brand for the time being. We'll see how long that lasts. And then you also have, and it's interesting here, we get into this interesting story that I got to write last year, and that is kind of the tightening of the relationships with the OSJs. And I think it's interesting that LPL has tightened the screws on the OSJs because the OSJs are generating all this economic value, but it's going to the private equity stakeholders as opposed to going back to LPL itself.
Yeah, that's interesting. And there's got to be a bunch of value on the LPL side, because you would think some of these OSJs would be really large RIAs if they spun out, but they continue to just stay on the LPL platform for one reason or another. So there's got to be a huge exchange of value happening there.
Yeah, absolutely. Look, we had Merit end up disaffiliating with LPL as a result of this. And look, they just got a massive transaction done. Stratos, they just got a deal done. I believe that they're still staying with LPL. But yeah, SCI came in, made a big investment in them. That's actually a rival custodial platform to LPL.
Right. Yeah, it's interesting too. I mean, SCI is a good one, but LPL, I remember when I first got into the industry, how difficult it was to fully understand, like, okay, LPL is a broker dealer. I got it. Like, they're an independent broker dealer, advisors go there. And then somebody's like, yeah, they're also an RIA. I'm like, how does that work? And they're like, this is a corporate RIA. They have advisors that sit under that. I'm like, so they're an RIA and an IBD? And they're like, yes. And I'm like, okay, got it. I'm like, I think that makes sense. There's enough advisors. And then later somebody's like, yeah, they're also a custodian. I'm like, wait, like Schwab or Fidelity? And they're like, yes, exactly. And I'm like, so they're a custodian, an independent broker dealer, and an RIA. And people are like, yes, that's exactly right. And then it just kept going. And I was like, man, this is like enough to make my head spin, because you think all of those are individual buckets, but that's one of the reasons too, like you're saying, they're a very fascinating company in the space.
Yeah, exactly.
All right, let's pivot a little bit. You were on The Unlock with Michael Batnick recently, and you had this quote that I wanted to dive into a little bit, where you said that our industry is like a fancy beach house that's built against the building code. What do you mean by that?
So the reason that I use that analogy specifically is because everything looks great. Everybody's high-fiving each other. We have all these big conferences where we celebrate how great the industry is. And look, there's a lot of tremendous things happening here, but I think that there are kind of signs of stress underneath the surface. And it makes me wonder what's going to happen when a market downturn inevitably hits. Look, again, not to get too cliche, but everybody looks like a genius when we're in an 18-year bull market, right? Everyone looks smart. And I just think about how some of the institutionally backed firms in this business reacted in the brief instances where we've seen market stress the last couple of years. And so we'll go first to 2020, where we had COVID happening, and we had so many of these institutionally backed firms take out PPP loans. And look, I think that as a corporate fiduciary, taking out a PPP loan was absolutely the right move, but you had to attest to some pretty serious things about what would happen to your company if you didn't get that money. And you look at the rush of the firms with institutional capital partners that took that route and having to attest to those details, well, that's not a good sign. And then the second thing, building off that, was what happened in 2022 around the Ukraine war. And think about how many of those institutionally backed firms, some of which we've discussed before, they took out preferred equity with PIK functions. And look, I said I used to cover distressed debt. Anytime I see a 12 to 13% PIK, I think about the distressed oil and gas explorers in the Permian Basin that issued those kinds of notes before filing for Chapter 11. You factor in that and you look at the leverage position of some of these firms. I mean, Hightower was fairly highly levered at points in 2021. I believe they got to as high as 10.7x. We reported on Focus and Mosaic carrying out either dividend recaps or debt refinancing, which have turned their leverage positions a little bit higher. So yeah, all this stuff looks great as long as the market goes up. But if we have a 1 to 2 year downturn, I am going to start to worry, are we going to see firms trip covenants? What is going to happen? What is going to happen around those kinds of details?
Yeah. Interesting perspective. And do you think that's one of the reasons why there's such a focus on organic growth right now? Because a lot of the inorganic is where all the leverage is coming from, right? You're borrowing this money, you're doing all this, and everybody's saying now, hey, we got to figure out how to grow. We got to get all these firms that we're buying to grow. You got to wait to or balance the scales a little bit.
Yeah, I mean, I think that's what makes 50 Growers, I think, honestly, an important project because, to be honest, the kind of dirty secret of the RIA industry is that a lot of firms don't grow at all. They don't grow organically. In fact, they're probably net negative flows, and it's the market appreciation that's propping them up. And so I think that a project like Growers shows, yeah, it's really, really hard. It takes a massive investment to grow organically. And these are the firms that do it. And maybe they can be an example if you're an early to mid-career advisor of how you can do it. So yeah, I agree. Like the firms that can grow organically, I think one, it's interesting to note that, let's take SAN, let's take Schwab Advisor Network. That's not a cheap way to get new client assets. When you think about the referral fee you have to give Schwab in perpetuity, that takes away half your margin on a client instantly.
Right.
But if you're someone like a Minetti Group, where you have your own in-house training program they call Minetti University, and you can teach your early career advisors fresh out of college to go out and prospect and get into meetings and talk to centers of influence. Well, that's a lot cheaper and a higher margin way to grow and get new clients in the door than paying Schwab in perpetuity. So the firms that can grow cheaply and efficiently, I think, are poised to win disproportionately the next couple of years.
Yeah. The Minetti training program is a great example. I'm curious, as you did this Growers project, was there any other programs or things that you heard about that stand out? And while you think about that, I love that you called out the growth rate, because I had somebody else on the podcast that noted, hey, everybody touts the organic growth rate for the RIA industry is about 2% when you remove the market, when you remove all of those things. And they said, but if you take out like the top 10 firms that are growing, it is actually negative, which is crazy to think about, how all of this is working. So the industry needs to change the tune on this. They've got to learn how to market. They've got to learn how to go just beyond word of mouth referrals, which is how this industry has been built on word of mouth referrals and the market going up and to the right. And I think the demand is high enough that proper marketing technology and tactics can help people grow organically. But what are some of the unique things you're seeing besides that training program amongst the 50 growers?
Yeah, I think a good example, and this gives me a chance to highlight a firm that's not a household name, and that's up in Alaska Wealth Advisors.
Yeah,
we did some talking to them, and they actually had a really interesting approach to managing the client relationship, which I found fascinating, which is that, if you know Angie Herbers, the industry consultant, she used to write for us, might be writing for us again soon. Alaska Wealth Advisors used this diamond teams model that Angie helped create, in which advisors work with a client in a team of 4, where you have a senior advisor who's the one that's the rainmaker, going out, leading, generating new business. You have 2 lead advisors who manage the client relationship. Then you have a trainee or an associate advisor, entry-level person, working beneath the 2 lead advisors. So you have people working at each different spot of the kind of advisor-client relationship. And you give, and I think this is what's critical, having not worked in an RIA myself, but you give the entry-level employee the chance to learn on the job and a set of clients to take care of, as opposed to setting them off on their own. And so I thought that was very interesting from an organizational structure perspective.
Super interesting. All right, let's pivot a little bit to talk about Milemarker as a technology firm. I'd be remiss if I didn't ask you any common themes or shared themes on technology in the 50 growers that you found.
Yeah, I mean, that's a good question. I'll be honest, we haven't done a super, super deep dive into technology, but I would say that just from a top-down perspective, I mean, again, I would go towards the themes of streamlining, operating efficiently. I think that TAMP's obviously popular, outsourcing the investing aspect of your business. Automated marketing campaigns work well, obviously. Yeah, I mean, those 2 things kind of stand out, but it's tough because I think sometimes this is not necessarily a failure of us, but I think that we can do better, is that I think that sometimes we could probably do a little bit better job covering technology in detail on a day-to-day basis. And that could be something we could do in a follow-up story down the line.
Yeah, very interesting. All right, outside of organic growth, what other challenges are you seeing amongst those firms that are in the 50 growers?
Yeah, I mean, I think the organic growth is obviously one thing. I think the other thing is, and look, this kind of leads into a follow-up story, is that I think that if you're a smaller firm, I'm just talking about like getting on the list. If you're a smaller firm or one that doesn't have the institutional backing, in one of these highly competitive, highly populous states, it can be tough to kind of get yourself noticed. I mean, I'll pull up right now. I've got New York in front of me. So our top three, you've got Cerity Partners, which has backing which is Genstar controlled. You have Stewart Partners, which is backed by Sinosure and the Pritzker organization. And you have Wealthspire, which we just reported that Aon is trying to sell. That's three firms with institutional backing. And I think what I found is that in those highly populated, dense, competitive states, it's very tough to get noticed. You see a lot of repeat names year after year after year. And that's where marketing comes in, right? Like you have to get your name out there against the household names.
Yeah, not only New York, especially if you bring up New York, that's also super prevalent for the wirehouses too. So not only is Cerity and Stewart and Wealthspire, but also huge presence of Morgan Stanley and Merrill and UBS and Goldman and all of those guys too.
Yep, and you got Summit Trail, BBR, all the private banks. It's an intensely competitive market. Those are the challenges of getting any RIA off the ground.
Yeah, no kidding, man. All right. Let's pivot a little bit and just back up and talk about the industry as a whole. If you were to get out your crystal ball and look into the future a little bit, what are some of the trends that you see coming down the pipe? As if you guys don't see on the video, Ian just shook his imaginary 8-ball. What are some of the trends and predictions that you see coming down the pipe that people should be preparing for?
It says ask again later, but nah. No, but I think what I find interesting, it's the idea, and this comes hand in hand with the consolidation, the maturation of the industry, is that I think for a long time, probably up to when I even started in the business in 2018, 2019, the RIA industry felt kind of like a little bit kumbaya, where everybody felt like they were on the same team against the wirehouse, against the private banks. I think these businesses have grown large enough to the point that they're starting to get internally competitive with each other. And so what does that mean? I think that leads to one, stiffer and less friendly competition for advisory talent and litigation that comes downstream of it. I mean, I think about, stuff we've written before, there's litigation between LPL and Ameriprise. Right. We have litigation that's touched on companies like Edelman. We have Mariner Wealth and Savvy in litigation with each other. And so I think that the competition for talent, I think, is something that's really kind of far downstream. And I think what goes with that, I think if you want your advisors to stay in the building, you have to incentivize them to stay. And I think that if I was an advisor or a CEO at a growing firm, I think about what are the approaches that I have that can give my entry-level to mid-level employees skin in the game and keep them incentivized for the long run. I'll circle back now to another one of our growers firms, and that's Dakota Wealth Management, which is down in Florida in Palm Beach Gardens, led by Peter Raimondi. Yep. I mean, they've got I believe the number is, about 79 employees, and I think that north of 70 have equity. And that includes everybody from the receptionist to the top executive team to advisors. And so if you incentivize people to stay, one, you make it a lot easier to pass that equity down from generation to generation. And two, you keep people around, you keep people happy. And so I think that it's the blend of the carrot and the stick to retain talent. That's a trend I'm focused on.
Yeah, it's interesting to talk about talent because everybody's talking about AI, right? And AI is supposed to just replace all of our jobs, although I think we're really far away from that. But it sounds to me, what you just said, and I've heard other people talk about this too, is, in some ways it might make talent all the more important as we go forward.
Exactly. And look, let's take AI a little bit. When they think about how AI might apply to me, AI isn't going to take my job in terms of finding out information I'm not supposed to know and sharing it with the world. That's a talent that I've worked on. It's a talent that our team at Citywire has worked on and put a lot of time and effort in. Look, AI can probably write a prospecting email, but can AI build the kind of relationship where you have an advisor and a prospect doing 18 holes together, talking and making them feel comfortable with each other? No. And so I think that AI, those types of technology that smooth out our online interactions, I think that it makes those soft social and people skills that much more valuable.
Well said. All right. I want to put your personal talent to the skill here. So Super Bowl 37.
Super Bowl 37. So that means that you have a Falcons football behind you. So I'm curious why you are talking about a Tampa Bay Buccaneers Super Bowl title.
I was trying to pull a tough one out for you.
So Super Bowl 37 was Buccaneers 48, Raiders 21. The
Yep.
game was played in Qualcomm Stadium in San Diego. Opposing coaches were John Gruden and Bill Callahan.
Okay, that's a good one.
Opposing quarterbacks were Brad Johnson and Rich Gannon. Gannon shared MVP that year with Steve McNair. The Super Bowl MVP was Dexter Jackson, who had
Okay,
two
that's a
picks.
good one.
And then I tried for a lot of these, I try to give scoring summaries.
Yeah.
So it was actually relatively close for a little bit. The Buccaneers had, I believe it was a Keenan McCardell touchdown. You can pull this up. There was a Dwight Smith pick six. There was a Derek Brooks pick six. The Raiders had I think a long touchdown to Jerry Rice, and they had a blocked punt return touchdown too. They actually made it a 2-score game before Gannon threw 2 pick sixes to basically ice it for Tampa.
Yeah, man. The Dexter Jackson poll on the MVP is pretty impressive. A lot of people probably don't remember that because Derek Brooks had such a good game. That was also the crazy one of, would you argue, was that the last Super Bowl won by a game manager quarterback?
No, I don't want to make any of my Eagles fans mad with my critique of Jalen Hurts' ability to throw beyond the 1 to 10 yard window in the middle. I'll hold my tongue on that one.
Okay. I got you. Yeah, I do have a Falcons football behind me. I'm a tremendous Peyton Manning fan as well, or was, as he's since retired. But I couldn't ask you about the 2017 Super Bowl. That was just too painful for people who live in Atlanta. So, all right, let's move into the final segment of the show. We call this the Milemarker Minute. It's a series of lightning round questions where we aim to get to know Ian a little bit better outside of being the editor at Citywire. So you ready for the Milemarker Minute?
Shoot.
All right. If you could travel anywhere in the world you've never been to before, where would you go?
Ooh, that would probably be either Greece or diving in the Great Barrier Reef.
Oh, like it. Who's the greatest sports broadcaster of all time?
Kevin Harlan. I love Kevin Harlan because Kevin Harlan gets excited about every single game that he watches. He listens to NFL Films music alone in his hotel room to pump himself up before calling a football game.
That's amazing. If you could go to a Super Bowl at any of the stadiums in the country, which one would you choose to go to and why?
You want me to pick like a past Super Bowl I could have gone to or a future Super Bowl?
Like a future one.
So I am trying to see the Giants play in every stadium.
Okay.
I would say the stadium on my list that I'm probably most excited to see in the future would be Jerry World in Dallas. But I don't think they're going to get a Super Bowl again anytime soon.
Yeah, it's going to come back around in the future. What is the best flavor of ice cream?
Oh, this will make my wife so mad. I love anything that's rainbow flavored. And then she'll go, oh, rainbow sherbet's not an ice cream flavor, to which I say, it is to me.
I love it. What's the best book you read or listened to in the past year?
Ooh, that is a very good question. So I'll give 2 recommendations. One is The Fund by Rob Colt from the New York Times, which is a really good, it's like both a biography of Ray Dalio and a kind of a deep investigation into Bridgewater Associates. And then I also started reading a great book. I finished this a couple weeks ago from Frank DeCotter, who is a Dutch historian. And I read his book about the Great Leap Forward, and that's called Mao's Great Famine. And there were just moments in there it made me think just how absurd, like tragic to the point of absurdity. It was a tremendous history book.
That's a great place to end it, man. Thank you so much for coming on the show. I loved your insights on what it takes to get onto the 50 fastest growing firms in the country to be a 50 grower. I love the talent. I had no idea about you knowing about all the Super Bowls. So that's one of the things I love. I love this.
It's great at parties.
It is great at parties. That's pretty impressive. And that's one of the things I love about The Next Mile is, you've been around the industry for a while. We've crossed paths a couple of times, but you come on this and you get to learn something new about somebody still. So thanks so much for sharing that and for the deep insights on the industry, sharing everything that you're learning.
Thanks for having me on. Let's hope to do it again soon.
Yeah, of course. All right, everybody. That's been another episode of The Next Mile. Please make sure you click follow or subscribe wherever you're paying attention to this. And if you wouldn't mind, leave us a review so that somebody who's never heard of this show before may stumble upon a great conversation like the one I just had with Ian. But until the next episode, enjoy every mile.